All right, guys, we're live. Hey, everybody, welcome to Arch Public. We're going to talk today about Bitcoin's new all time high, hitting 112, almost right on the nose as I'm looking at it. 112,006 and 21 cents is the new all time high for Bitcoin, depending on whatever exchange you're looking at. We're taking a look at Gemini, but 112,006. We've got John Deaton, Dave Weisberger, Tillman Holloway, Daniel Evans, all here today to talk about why we're here, how we've gotten here, and where we're headed in the future. So let's talk about it here today. Dave, I want to start with you. You're an analytical guy and have a long history in markets. All the way back to Solomon Brothers. So, what do you see, and how do you see it? How have we gotten here over the past 45 days? We're up better than 40% from 74.75 all the way up to 112. What do you think has pushed it to this point? And do we stay here? Do we move higher? Is there a pullback? Give us your thoughts.
So, yeah, the 74 was really like a V, really intraday V bottom. It didn't really get there. I mean, it was around 78 was where it was actually trading a reasonable amount. I called it a tradable bottom at the time. It was a triple bottom. It's on. A good thing about X is it's there. You can look it up. I don't have to brag about it. I don't really care. But my reasoning then is it's played out exactly as I said. There's a lot of institutional demand. It's passive, it's algorithmic, and it's driven by people on the professional side that are accumulating, whether it's using Coinbase's algos, my old firm Coinbase, CoinRoute's algos, Talos's algos, or they're using OTC brokers who use their own algos or one of the others. And what does that mean? That means that they're not chasing, they're not FOMOing, they're not buying in huge prints to push the price up. They're just sitting there and they're going to float with the market. And as long as they can get their volume done participating in line with the market, they'll sit there. As soon as the selling abates and they can't get enough done, they'll have to ratchet up the pressure. And so we've seen that repeatedly over the last few weeks. It's that grinding higher. It happened to coincide with the relief, and I'm putting air quotes on it. You can't really see it with these green screens behind me, of Scott Bessent being more responsible for economic policy, and we saw a corresponding rally back in risk assets at the same time. But Bitcoin has been trading, delinked from risk assets some days not, delinked from gold some days not. The truth is, the big driver for Bitcoin is monetary debasement. And the reason for this last push and the one that's going to sustain this push is the fact that the big, beautiful bill, as John lamented on X not too long ago, isn't cutting anything. And our deficits are going to continue to go higher, which means we're going to have to print more money, which means that if you want to store a value, you could either have the melting US dollar or you can buy Bitcoin. Or you could buy gold, I suppose, as well. I put out the analysis a couple days ago where I think Bitcoin will go with regard to gold, and that number over the next whatever, call it a decade, I don't care. It could be a year, it could be 10 years. We will get to 900 some odd $1,000, $20-25. So if the dollar continues to debase, that number will obviously go higher.
Yeah.
I'm not saying it will happen tomorrow. I'm just saying that's sort of what I consider to be the first stop on the Bitcoin train. So when you look at that, and I will tell you, because I've talked to many of them, this is the important point. Most of the people buying and accumulating Bitcoin look more like me, like actually most of us on this panel, than the young kids. We've seen a lot of the Bitcoin billionaires and decamillionaires and centimillionaires selling Bitcoin to these pools of capital over the last month and a half to fund their lifestyles. I mean, someone has to have the boat that I could look longingly out of my balcony from my condo and see. There's a 120-foot boat on a $40 million house across the bay from my condo. But, whatever. Not mine, obviously. But, you got to buy it with something. So you've seen a lot of that. And I do think that unless there's a massive change, something geopolitical, I think this rally has legs. I think it's a grind higher rally. It's not a swoop. I mean, it feels like a lot. Melker said it really well earlier today. He said it feels like Bitcoin's up 20%, but it's really only up 2%, which is nothing. And that's true. That's what these rallies look like. They look like a couple percent every few days, and you look back after a couple weeks and you say, "Oh my God, look what we've done." And I think that's what's going on.
Well, we've moved into almost a TradFi mentality where when Bitcoin is at this level, above 100K, dollar version movements aren't what they actually used to be, but people still like to talk about them, right? People still like to talk about 1,000 point move in the Dow or a 700 point move in the NASDAQ. While that's interesting, it's not the percentage number that it used to be in '08 and 2009 and 2010. Very, very different worlds, right? Same here. Bitcoin could go up 2 to 3% from here, and most of crypto Twitter would lose their mind. But in reality, it's a fairly small percentage movement, right? It's a fairly
Yeah.
small percentage. By the way, we could go down to 3, 4% from here. People will lose their minds. But again, it's a very small percentage from where we're at. Tillman, your thoughts?
Well, I concur with pretty much everything that Dave said. I think he's spot on. I do think that what we're seeing right now with MetaPlanet specifically, and some of the other traditional finance tools that give you access to Bitcoin, Michael Saylor, what David's doing over with BTC Media and Nakamoto, like that has just begun. And if you look at what's shocking to me is how much capital they're able to raise and how there's this insatiable desire for this asset class. And, I hate to even say this, but I see it this way and I believe it to be the truth. I think we haven't scratched the surface as it pertains to traditional money wanting ways in which they can gain exposure to Bitcoin. And I think that that's going to be the real difference maker in the next bull markets and really from here going forward. And I said this a while ago, and it's becoming more and more clear and more solidified. The first bull run or a couple bull runs that I was able to participate in was driven by the miners. They were the market makers. They had the majority of the supply. They were the ones that controlled the price based upon whether they all started selling or they all started buying or they held. And that really was that was the driver of price. And then you had the next wave was driven based upon the ICOs and this huge pump and cycles, and I would call that the period of time that was controlled by the crypto exchanges. You look at like exchanges were made and died on the sword of did they have the latest ICO and could you buy the latest ICO from them, and it was this race to compete to launch these ICOs, and the liquidity followed them, right? And that's what drove the market was the exchanges. Well, I think we've completely shifted off the exchanges now. I do not think the on-chain volume is near what the off-chain volume is, and I don't think we've again scratched the surface. So I would anticipate Wall Street money to continue to pour into this vehicle and into money supply when as soon as the printing presses start humming again, which they already are. That money has to go somewhere. And to Dave's point earlier, like what's a better asset to put it in? And I think the keynote speech that Saylor did at this last conference that he put on just hit the nail on the head. You're half the return of Bitcoin, even putting your money into the Magnificent Seven. So if you think you're lucky enough to always have your money in the Magnificent Seven, you're still out, underperforming Bitcoin by 50%. That's a number that essentially, from a mathematical perspective, should point every corporation on the planet to the fact that they have to have exposure to Bitcoin to keep up with the competition, because you can't even get that return investing in yourself if you're Nvidia. So, what other vehicle are you going to compete with that type of return over a 15, 16-year time frame? So I think the corporate adoption, I think this whole leverage debt mechanism and the Bitcoin purchases in the public sector, I think those are huge things that have just begun. And I think those are going to be big drivers moving forward.
John, talk about your experience. As you've told many, you've got 80% of your net worth in Bitcoin. That's got to feel
It's
pretty
a
good
good
today.
day. It's a good day.
It's a good day to be John Deaton, right? It's a really good day. So talk about what it feels like, just individually, and all the cycles that you've been through yourself.
Yeah, listen, I believe it's still the most asymmetrical bet trade that you can have. When we look at, I said, and I know Dave agrees, all path leads to the printer. All paths. Republicans in charge, Democrats in charge. They just don't have it in them to attack and try to do a balanced budget. When you look at the big beautiful bill, it's big, but we're gonna rely on a future Congress to cut spending. What? That's literally what they've done. And so you're going to reduce taxes and spend more than you bring in. It just, what other bet do you have? I think, when I had my money in Bitcoin 5 years ago, I think there's a better case for it today than I think 5 years ago it was the best bet, I believe, but I think it was more riskier than it is today. We're witnessing institutional FOMO, which is going to be followed by possibly nation state FOMO.
Right.
The there's still talks about Bessent's going to revalue the gold, which would be a 800 billion revaluation instead of the $43 or whatever it is an ounce historically. I just don't see what other path you have. If you want to preserve capital, where do you put your money, knowing that we're going to be running $2 trillion deficits for the next 5 years? I mean, what are you going to do with your money? So, I think that we haven't even experienced. Google searches for Bitcoin are at a historical low.
Yeah.
I mean, I just saw today Saylor's doing another 2.1 billion. I mean, like, he doesn't have enough. I think Mahler's and Metaplanet and Bailey with his new thing, and now you got Pomp going with a SPAC and everybody. I think we're literally witnessing institutional FOMO into a asset class that we haven't witnessed before.
And it goes to the question that I just posted there. The traditional 4-year cycle is broken.
Yes.
I think absolutely yes.
Could I explain why? Because math.
We're watching it play out in price action literally as we speak. Like previously, when we hit new all-time highs in other cycles, there'd be a precipitous drop either in hours or certainly in days and weeks. And that's just not happening. The bid associated with Bitcoin is extraordinary right now. And to Dave's point about people that are buying Bitcoin look like us, right? That's because the Pharisee for that group of people is Larry Fink. Like he's out there being an evangelist for Bitcoin in a way that I never could have imagined. And those people are like, yeah, I've got 42% of my entire portfolio is made up of BlackRock ETFs. Oh, they came out with a new one that's doing pretty good. Sure, I'll punch a bunch of money into it. That's the nature of what's going on here. So is the 4-year cycle dead? Yeah, I absolutely think so. Dave, your thoughts?
So I think the math says dead is the wrong word. I mean, we always like to think in binaries because we're humans, right? So I always like to explain quantitative finance. I explain them in binaries, but understand that it's a smooth curve. So the 4-year cycle in the beginning, the Bitcoin block reward, the difference between post and pre-halving was a massive difference in the supply-demand dynamic on a daily basis for Bitcoin. So of course, the ability to see that there were 6 months post-halving that it could sustain the halving decrease without mining collapsing and with the network growing was a huge deal, and it led to big rallies. Okay, this last halving, the difference between pre and post is less than Saylor's buying per week himself, and not by a little, by a lot actually. So the amount of difference in the supply is just not that big of a deal. Once we went below gold's inflation rate, which was not this halving, but the halving below before, Bitcoin was already at the point where even if there wasn't another halving, even if it wasn't fixed at 21 million, and it was fixed and the mining was just going to stay that way forever, it was already a lower inflation than gold with absolute certainty. So, Bitcoiners like to point at 21 million. Honestly, I couldn't care less. The only thing that I could care about is certainty. So if we froze the block reward where it is today, I don't think we need to do that. I think that it's pretty clear that there's no need for the security budget to do that. But if you did, which is like the worst possible case of all the techno doomsayers about Bitcoin, if you did, it would have an inflation rate 1/4 of what gold has in terms of what we pull out of the ground every year, which is still the hardest asset on the planet. So I don't think the math justifies a 4-year cycle being as meaningful. Now, there is a 4-year cycle politically that is meaningful, right? And that matters.
It's a different 4-year cycle.
It is different, but interestingly, it coincides. So, we had an election in 2020 where we ended up with a president that everyone thought, oh, this will be okay. And there was an executive order early in his presidency. And then he brought in Gensler, who's an MIT blockchain professor. And everyone was like, oh, this is great.
Yeah.
And then the hammer came down. And it was, and some of us, John being probably the first among us, to realize this isn't going to be great because the past SEC wasn't great and these guys are not going to be better. And then we watched Operation Choke Point and we saw all this. And then we had a new president that comes in and says, and he just tweeted it out before, we're going to be the crypto capital of the world. And, he loves Bitcoin and he thinks it's going to go higher. And what is that code for? Well, that's code for he realizes that it's an asset class that can make his family a absolute, excuse my language, fuck ton of money. And he's going to do what he can to make that happen. And he's telling people, unlike other presidents and unlike other politicians who reserve their insider trading for themselves and their families, he is telling everybody what to do. So if you're listening to him, you're going to make money right along with him.
It's not even insider information because he tweets out. Great time to
The
buy.
whole bottom of the stock market, the Bitcoin market, all the markets, Trump tweets out an hour before. He gave you an hour. He said, I'd be buying here if I were you.
Well, I will say
Whereas
this.
if his name was Nancy Pelosi, he would have already cornered the damn market. He fought for himself and not told anybody anything. And I laugh about it because, the libtards give me all this grief. Now, look, I am not a massive supporter of this administration. I am center right. I do lean Republican. I agree with a lot of what this administration is doing, but there's no way you could fault that. That's what you have in the White House. And so I've said this many times. Do you really want to fight this? So to the degree that he only has 3 more years or 3.5 years in his administration, that's a 4-year cycle that might actually matter because we're going to care about politics. But I don't think the halving cycle is nearly as important anymore just because of the math.
Yeah, I couldn't agree more. And I think I was suspicious of the crypto ball that they had, a couple of days before, but I heard that the whole Trump coin wasn't announced there. So even in those circles, it did not leak to any of the insiders. The first people that heard about it and profited from it were the people that were following him on Twitter and saw him tweet out about it. And it was kind of that was the starting gun essentially. So, he is, abiding by a fair and equal shot rule, which is refreshing, to be honest with you. I mean, IPOs are notorious for picking and choosing who they want.
Oh boy, you don't want to get me started on that one, Tillman.
Yeah, well, I mean, it is. I mean, it's access, by relationship, and at least this is kind of a fair starting gun.
Let me say this about that because this is I spent a lot of time on Wall Street. The IPO calendar is considered currency on Wall Street. Now, let me repeat what I just said slowly and explain what I mean. For investment banks, use access to getting allocations in IPOs in a hot market when the markets are hot. They use that access as an incentive to get orders and commissions on trades, on other trades, not just in that IPO. So one of the reasons that people will trade with, I don't want to pick on anyone in particular, Morgan Stanley, Goldman Sachs, whatever, it doesn't matter, is because they have great IPOs that they could get access to. Now, if you think about that rationally, your brain starts to hurt and you realize, and you start going down the rabbit hole of saying, well, why do we have this? And the answer is something called the accredited investor rule and other rules that make no sense that crypto doesn't have. And we're going to end up with a reckoning at some point. on this, but it's a very big difference. The point about Bitcoin is its genesis was its genesis. I was not smart enough. In fact, I was an idiot naysayer. As I was thinking about it, and people were trying to convince me, I'll never forget it. It was like between like $600 was where I said, well, I'll watch it. Let's see. It went to 1,000. It came back to 600. The second bite of the apple, I was like, well, maybe I really should. How do I do this? Oh, I don't have an account. What am I going to do? Yada, yada, yada. And ultimately I missed it. And then 2017, my son brings me back into crypto. We start CoinRoutes, and well, it wasn't the bad time to do it, but ultimately that's when I got started.
This is a tweet that I wanted to reference real quick that you put out today, Dave, that I wholeheartedly agree with. And it's a reference that I made a couple weeks ago on probably Melker's podcast. I don't know. I talk too much all day long. I referenced this at some point in my communications with someone, and it's the reality that don't we think Bitcoin at some point gets and surpasses just the price of Berkshire Class A shares, which I think right now are right around 800K, right? So, Berkshire Class A shares, what does Berkshire do? It's like, insurance and railroads and, Dr. Pepper, who knows what, right? It's the most uninteresting businesses in the world, and it trades at 800K a share. Aren't we in a position where over time, per your tweet right here, don't get bogged down at 100K for, per Bitcoin, we're going to surpass something like Berkshire in that share price, that 800K.
But Berkshire created a B class share so as to get
Yeah. No, I get that. Berkshire A and then Berkshire
Bitcoin
B.
doesn't need it because you could buy 0.1, 0.01.
Right, of course. But to your point, at some point we go there. I always find it interesting too that in conversations on Twitter, the last 3 people on earth that are anti-Bitcoin will pop into my replies and say, well, Bitcoin's only, I'll say something like Bitcoin's up 40% in the last 45 days or whatever it is. And somebody said, well, it's up 40% in the last 4 years. And the reply to that is, have you considered inflation in the last 4 years? Maybe you should add that to the number.
I want to make a point because I argue with Mike McGlone about this every freaking Monday. When you pick 4 years, you're picking 2021. Yeah. 2021 was a unique period. It was a period of time of maximum euphoria because of Biden's executive order and the thought process that everything is going to be hunky-dory, etc. The leverage that was in the system when it hit 60 some odd thousand was insane. People were paying 100% annualized interest to be able to have the right to use those funds to buy Bitcoin on leverage. On exchanges, and the leverage, the volume on the perpetual swaps was 5 times what was going on in spot, and so all the buying was that way. And then
people were doing 125% leverage.
Yeah, they were. It was crazy crap. And so people were paying, they were doing this. And at the same time, what happens in 2021? Well, the GBTC, because of futures and because of a bunch of reasons, the premium collapses, and all of a sudden the wheels are set in motion. Earlier, people don't know this, or a lot of people don't. Maybe you guys do or don't. But there was the reason that BlockFi and Voyager and Celsius were able to offer yields that were really high in 19 and 20 was because there were huge arbitrage spreads between different exchanges in Bitcoin. So like if someone was using Arch Public trading on Gemini and another one was using Arch Public trading on Kraken, if you had it, it could have been hundreds of dollars of difference between the two.
Right.
Now, that went away. Why did it go away? Because a little company, not so little anymore, called Fireblocks, got all the exchanges to sign up to their network and got the exchanges to agree that if a transfer from Kraken to Gemini went, and they saw it on the Fireblocks network, that as soon as the first block confirmation happened, which was generally within seconds, that they would accept it as good and allow people to trade. And so the arbitrage spreads closed within 30 seconds or so down to it. And it got much, much smaller. So all of a sudden, the demand to borrow Bitcoin was way, way less. And so the knock-on effect was by 21, these companies were still offering these big yields. They had to do stuff. So BlockFi just let their business quietly slip away. Voyager lied and took a loan from 3 Hours Capital. And Celsius lied and decided to prop trade with the money.
Yeah, and Genesis financed it all, and
Genesis did all of the above.
Yeah.
They were worse. They actually put in fake capital. They did a lot.
Right. Correct.
All of this created a massive bubble. The leverage that they created made the upside much bigger, which now we understand. And at the same time, once they collapsed, it was wave after wave of forced selling. And people in the market didn't know this. The only stat we knew, and this you could see, that was very obvious, was the ratio of the price of Bitcoin to the network, the hash rate of the network, was 6 times what it is today. Think about that for a second.
Yeah.
So if you're going to compare the peak today with no leverage built up in the system other than Michael Saylor, and his is relatively small and selling a different kind of leverage, one that doesn't come back into the price of Bitcoin, and the price relative to the hash rate is 1/6 was what it was. It's not remotely the same thing. And so people who keep looking at 2021 drive me berserk, because 2021 was a clear blow off top, a clear, misallocation, and then the result of that was a clear, obvious bubble collapse. And we saw it all. And in crypto, I don't know if any of you guys study biology. In biology, they use fruit flies and things because they have short life cycles. Crypto is a shorter life cycle than in traditional finance. So we basically got to see an entire life cycle with a period of 40 years. And so here we are. It's not a cycle, it's just what happened. And so, yeah, I get my backup about 2021. So
the leverage, nowadays, the big difference is the size that's happening in the space is associated with Bitcoin ETF flows. Like, nobody really talks about that anymore, but 6 months ago, it's all anybody talked about. And that's now this gigantic high floor underneath the price.
Did you remember? Anybody remember what? I remember when Galaxy came out and said that they predicted that in 2024 they would attract $15 billion in ETF. And everybody was saying
they were crazy. They were insane.
Yeah, except it turned out to be 60. Yeah.
Well, and it turns out that 1 year later, just BlackRock's Bitcoin ETF has $65 billion in assets under management. Right. They started out with 0 on a couple $100 million on January 11th to seed fund. So it just extraordinary high floor. Alan, if you can bring up that 2-month chart, Daniel, I want us to start to go through ways that frankly, the movement in Bitcoin, the volatility associated with Bitcoin. Dave talked about, places like BlockFi and others that, talked about yield and presented yield to folks associated with Bitcoin, but did it in a very, very different way than Arch Public does. And so, what we do is we take the volatility associated with Bitcoin and we harvest from it, right? Not only are we buying on down red candles, but selling on big green candles, 2.2x long bias, and doing it in a way where you end up with more Bitcoin and you end up with cash yield. So Daniel, kind of walk us through this chart. I know you spent a lot of time with our customers and clients. Walk us through what you hear and walk us through what you see in this chart.
Absolutely. Yeah. So this is a 2-month chart of BTC 6 hours. So there's 14 trades that have occurred in 60 days. Mm-hmm. And what's so special about that, from my point of view, is it's only entering the market when it knows that it can keep cost basis low, but also exit that entry point to the point to where it's creating that cash yield, where a lot of our clients say, hey, I want to be able to have a way that I can get yield, but keep control of my assets, and then take that additional yield and put it back into the arbitrage strategy. So just in this 2-month period, you can see the swings and volatility and exactly how that performs. So you've got the blue indicators. As you see the market dip, you see the entries occur. And then as we see those swings up, we see the purple indicators that show the sell-off. And in this strategy specifically, it's focusing on the majority is accumulation, but there's that cream that gets carved off the top that goes back into USD, then to re-enter the market as we see those volatility opportunities present themselves. So, as time goes on, we see much more activity because obviously we're chasing that opportunity we all, see daily with volatility.
Dave, talk about, what you see here.
I got to tell you something.
Go ahead.
John, go.
First of all, I want to give a shout out to Dan because he's phenomenal. And he's helped me and answered all my questions. And so I want to make sure I publicly acknowledge him. Dan, you're the shit, dude.
Thank you.
Um,
Very much.
I got to tell you, the difference for me is I've always held, and you know, as I've said many times, and I never really had anything to do with it, and I always would get disappointed if Bitcoin didn't continue going up. As someone who just owned Bitcoin or owned XRP or whatever, and then I'd look at it and say, "Oh shit," you know, I was hoping it had more legs. Now, I when I see it dip, I go to look and see if I got an email.
Yeah.
Because now it's a weird psychological thing where now you don't mind it going up and down. Like before, you're disappointed that it's not keeping going up. Now you went down and you're like, okay, my account's working without me being involved in it. It's just it's a very different, I'm just explaining a psychological kind of progression as someone like me is fascinated by this stuff.
I love that, and I'll just say it's the analogy I like to give is climbing up a wall, right? When you're climbing a cliff or when you're outdoors climbing, the further the distance is between the carabiners, the worse the fall's going to be. And so you want something that's putting carabiners into the cliff wall very systematically all the way up so that when the price does fall, you've got very little risk and it kind of removes the volatility of that fall. And that's what automation does, right? It just systematically puts anchor points and takes cash off the table when that volatility presents itself, so that you are never left kind of all or nothing or having too much riding on one carabiner, essentially.
What in the Sam hell is a carabiner? First,
You don't know what a carabiner is? Oh,
What
come
in
on,
the
Andrew.
Sam
You got
hell
to come
is
spend
a
some time in
carabiner?
Colorado. A carabiner is what keeps you from falling to your death when you're rock climbing.
Good thing. Look,
Yeah.
I have my perspective on this is you know, it's interesting to me because I'm trying to translate, you know, having worked at a place called Two Sigma and having run quant trading strategies for a decade besides that, you know, running StatArb and whatnot. What you learn is a very simple thing. The first thing you learn about trading is it's a lot like skiing. Now, what do I mean by that? When you're skiing, and I learned as an adult, so I am a crappy skier. I'm competent, but I'm crappy. Your brain, when you start falling, wants you to pull backward. You know, that's how we're hardwired to do it. But if you learned, you know that when you're skiing, when you're starting to fall, you really need to go down the hill to regain balance. Well, in trading, generally when the human emotion wants to sell is generally when you want to be buying, and the human emotion when you want to buy is generally when you want to be selling. So understanding that, quants have made a lot of money by taking a disciplined approach, pre-programmed based upon, unless things change, based upon, you know, rational entry and exit points in terms of relative to the market. So it's always changing. And then you implement a strategy. Now, before a company like Arch Public comes along, if you're a human, you're not going to do that. You know, it's really hard. I mean, there are some people you could program, you know, people have figured out how to program scripts in Python and whatnot to kind of give them points. And then they have to know and enter their trade. And so what you guys have done is implemented a system for people to do this without having to actually program it. They could research where the entry points and exit points are, and that's awesome. And, you know, they can use your system to do that, but it makes it simple. When I made the point in that tweet before about DCAing, yes, DCA dollars cost averaging is great. What's better than dollar cost averaging? Having a disciplined, systematic approach to knowing when to buy and allocate your money, when to take off a little bit off the top, but you're holding your core strategy. If you listen to anybody who I respect in this business who trades at all, you'll like Mike Alfred's a good example, and others. What they will tell you is they have a core position. Or Peter Brandt is a better example, maybe the greatest technician alive today. Great dude. He will tell you he has a core position that's long. He doesn't touch it. And he trades around his swing trades. The swing trades could be long, swing trades could be short. He'll go and whatever. But he has a disciplined approach. And to me, the essence of trading is discipline. And the best way to be disciplined is to be systematic. And it's that simple. And so when I see a chart like this, I see, okay, it looks like the majority of the time the signals are right and you're taking a little bit off the top, and every once in a while it's wrong and you get stopped out, and so be it. This is a sort of strategy that looks like a rational back test to put some money into. It doesn't stop you from having a core position though.
Yeah.
And that's important to keep in mind. So if you're John and you have you're in basically you say, okay, I'm going to be between, let's just pick a number. It doesn't matter. Let's say I want to be between 70 or say 72.5 and 82.5% of my net worth in Bitcoin. And 72.5 is my floor, but I'll be up as high as 82.5 if I see a dip. And then it'll lighten up on the way down. You'll end up with making more money than if you were just 80% the whole time, almost certainly. I mean, you pick the number. And I think, I don't know if those are the numbers that you're using, John. It doesn't really matter to me, but that's the point. It's a very rational, pragmatic approach, and it's tailorable to everybody's own investment strategy. And so that's why, I sat on the phone with Daniel yesterday getting myself configured for the same reason.
Well, the main thing is the emotion is gone. I'm a private pilot, and what you said about skiing, when you're about to face an aerodynamic stall in the plane, what you're supposed to do is dip toward the ground and force the plane down to gain speed. But it's intuitive. You pull back, right? And then of course you stall and you crash and you die. And so automation just takes all of that out of it.
We have a very morbid panel here. We got carabiners flashing. I'm always talking about hurting your legs.
I mean, listen, I bought XRP again when the SEC lawsuit. I remember buying it at 19 cents. I think my average was like 40 cents, and I got a decent amount. And so I swore to myself I was going to sell it at $3. I'm taking 25% off the table because, I've watched it fluctuate so much, and I didn't because I got greedy. I was like, no, it's going to $4. You know what I mean? And so all the way go back down to $1.95. And so you just take the emotion out of it and let it work for you without you doing much.
Yep.
We're gonna pull up a tweet here that Daniel put out a little bit earlier today that showed, it did a really good job of talking about since February 1st, all the trades that have been executed associated with the ARB strategy, that you ended up with a cost basis of $83,000 while realizing a cash yield of $21,000 along the way. So again, it's harvesting the volatility that Bitcoin is handing to you while, as Dave just said, you're holding on to a core position, right? So you end up with just using it since February, which, by the way, our suite of products have been free to users since February. A position that has a cost basis of 83K, if you just started there, and then given the case study that this is working off of, using $100,000, you would have ended up with a 20 more than 20% cash yield in just what is that, for 3 months or something? Very short period of time. Just extraordinary stuff. But again, you have to have a tool or tools that allows you to harvest in a way that you can't do on your own. There are a tremendous amount of these trades that are happening at 2 a.m., at 1 o'clock in the afternoon, when people are doing life. And unless you are sitting in front of your computer 24 hours a day, you absolutely cannot pull off. And I think therein is the real. We had a conversation with a customer that's a larger customer of ours, and he said exactly what John just said. He basically said, I've gotten to a place because of these tools that my anxiety of wherever price goes, it's gone. Because I know if we go down to 60 for some reason, I'm going to be buying all along the way down to 60, which is a good thing. If we rocket to 125, and this was before we had gotten to 112, if we rocket to 125, I know I'm going to be taking little pieces off, and I don't have to worry about that. it's absolutely changed how I think about, sort of engaging in the crypto space. He said it used to be that if I missed one of my podcasts that are important to me, I'd be thinking I'm behind. I need to play catch up. I need to listen to this, or I need to listen to that. All that is gone because of these tools and what they offer, the ability to capture performance, to capture opportunity, to capture movement in an automated way.
And one thing I'll know, just nuances that are impossible to execute or very, very difficult to execute as a human being are nuances like when you're selling out of your positions, you should be selling into strength, right? But that's a really hard thing to do because of what John just told us about his $3 mark. When the price goes over $3, you're sitting there going, "Oh, it's going to continue to go." And with the price crashes below $3, you're going, "Okay, well, I'm going to wait. It's going to go back up to $3." And then the price continues to retreat and retreat and retreat, and you get caught in these psychological battles that compound over time. They get worse and worse. And so when you're looking at every single candle that you look on any of our charts, you'll notice something. And it's a nuance that most people don't catch, but it's very, very important. You exit on green candles and you enter on red candles. And that's how you should be trading. But it's incredibly, even people who have traded their entire life, that's hard to do because when you're on a big green candle, your emotions telling you there's going to be another big green candle. I shouldn't sell. But the prudent risk management side should be going, wow, we've had a disproportionate rise in price over the time frame that I've set against that price. And we should be taking some off the table when you are that far ahead of the curve. When you deviate from the mean, disproportionate to what the risk reward is, you should be taking some money off the table. So just looking at our charts, just notice that every single entry is at the bottom of a red candle and every exit's at the top of a green candle.
So just think of what Warren Buffett always said: buy when others are what?
Selling.
Sell when others are what?
Yeah,
Pretty straightforward.
exactly.
It's not easy to do though when you're sitting at the key. I mean, listen, Bitcoin goes from let's say it goes up, what was it, 33 grand, 109 to 112, whatever. We know very well that Bitcoin could go to 120, just like that, right?
Yep.
Because historically, now it's been behaving much more, I hate to say it, traditional. Like it's been behaving very mature, right? Like it kept at 82 for a long time, and then it was in the low 90s for a long time. Then it was in the low ones, and maybe we'll see that sideways at the 110 to 114 level for a while. I don't know, but you're thinking, shit, I'm not going to miss out if this is a God candle. I'm not.
Yeah.
So you just
pull up a chart of the S&P from 2009 and for the next 10 years and look at what it did, and then look at and not just the S&P. Then of course, if you look at, there's individuals like Nvidia and others that are making it up, but grinding rallies are probably the strongest, most sustainable rallies. That's what it feels like now. But this being Bitcoin, I mean, it's one announcement from one thing that causes either to go, whoosh or boom. And, whooshes and booms happen, and they're almost always overreactions in both directions. I mean, just because I think Bitcoin is going to go dramatically higher than here, and I do, as my wife is fond of saying, trees don't grow to the sky. It doesn't, it's not the way things work. It's not going to go like, it's not going to just go whoom, God candle up. It's going to go, it's like that famous meme, the one that says what people think hodling is. And it's a straight line up, sitting there on a hammock, looking at beautiful women, relaxing. And then the other one is what hodling really is. And it's falling into a pit of spikes and fighting out snakes and, all sorts of, but that's exactly the point.
Yeah, and if you're moving, sometimes I think the market is built to get you to react. And so when you're reacting, you're really behind the trade, right? And so you see these people that are reactionary with their Bitcoin stack, and they always end up regretting it. And I spoke to somebody less than a month ago or a month and a half ago that panic sold 17 Bitcoin at $77,000. And you're just going, that ugh. But that, that is what sometimes this vicious cycle of like chasing your tail emotionally in the market, where I remember in my young days I'd be literally buying at the very top of every peak, and I'd be selling at the bottom of every single trough. And you're like, does the market hate me? Does it know what I'm going to do? Is it trading against me? But it really is at some level built like a machine to extract weakness, right? And just to extract people's money that don't have the conviction to ride the bull.
So,
And
so
if
there's, I'm
yeah, go
sorry.
ahead.
I was going to say there's a stream of finance called behavioral finance that they teach in some colleges. University of Chicago, pretty good. There was a professor. I don't even know if he's alive anymore, but one of the earlier ones we used to work with when I was at Solomon, his name was Joseph Lakonishok, and he used to teach behavioral finance and talked about, and a lot of the early quant models are built upon this, which is understanding why and how and the signals of when herd mentality will cause ups and downs, and it's almost always like that. The notion that retail buys the top in traditional assets is almost always true. Not always true. I said almost always true. It depends on the dynamic of what's going on. Crypto being a retail focused asset hasn't really been like that until now. It's sort of changing more into that thing. I actually don't believe retail will be buying the top. I think retail will buy the middle through to the top when they finally get back into Bitcoin, because right now it's not really retail led, it's institutional.
Well, there's just going to be an adjustment associated with how retail buys Bitcoin. Let's call it 12, 24, 36 months from now. And here's why. Because the Bitcoin ETFs exist, and because you've continued to see, for example, BlackRock integrate their Bitcoin ETF into other ETFs and other holdings inside of their ecosystem of products, right? So there's going to be a proliferation of that product and other products that find themselves into 0.5% of this portfolio, 1% of this portfolio, exposure over in this portfolio. And all the time, that money is just continuing to funnel into spot Bitcoin, right? So that's going to grow, and crypto Twitter is not going to talk about it. They're not going to notice it. Most people aren't going to be aware of it. But that's the reason why, to your point, 2009 S&P chart till now, why are the biggest ETFs, Vanguard's S&P fund, BlackRock's S&P fund, there's a never ending bid associated with boomers going into those products. It
Right.
happened. All the plans, all the 401ks, all the savings, all of that stuff is associated with a percentage commitment to the S&P. And over time, there will be a percentage commitment to exposure to Bitcoin. And we're just at the precipice of it, which again, why over periods of 3, 5, 10 years, we are dramatically higher than where we are now, if only for that type of bid and reason, right?
And I think you're hammering on a nail that's really important, because the Wall Street growth is happening right before our eyes. The corporate demand is happening right before our eyes. And then at the same time, you're seeing the cold storage / exchange be under duress. We've seen some of the biggest hacks in the industry's history in the last 3 months. And this Coinbase thing isn't a small little deal. I know several people that have lost 3.7, $4.5 million. And it wasn't because of a hack. It was because their information was leaked at such a granular level that the con artists were able to impersonate a Coinbase employee and get them to send their crypto to the fraudsters. We're talking about that at $500 million scale. So I think we're going to continue to see things like that happen because the scammers are going to be more and more enticed to scam the liquidity in this market. And I think that's going to push a lot of people to realizing, like, you know what, I want exposure to this asset class, but I don't want to manage it because the risk is it's too big. And that's why I think some of the things that I'm most excited about in the industry are like Caitlin Long's story about them creating a deposit token, and it's a US dollar token that's being used to transfer international settlements. And what's great about that is those transfers are FDIC insured. Even if you have the base commodity of Bitcoin being the deposit of record at the bank, they're not sending the Bitcoin in that transfer. So if there's an error, the FDIC covers it and insures it, and we move on down the road. We can't have the things that happened, like with North Korea, where how many billions of dollars got hacked by Bybit and got funneled into really bad organizations that it's just a mar. And so I do think that not only Wall Street products are going to grow and attract more liquidity, but it's going to become less and less attractive based upon a risk perspective to hold the asset yourself. That's kind of where I see it, but I know it's not popular opinion amongst.
Well, no, can I take? I want to explain two things. For the Bybit one, you're 100% right about. I mean, that was serious human error and a serious problem, but that hasn't happened with Gemini or Coinbase or Kraken. They take it more seriously, etc. Bybit will take it very seriously from now on because it was existential. But the Coinbase hack, let's call it what it was. The same thing happened with Equifax. The same thing can happen, and fraudsters can conceal your. Unfortunately, my dog is barking, and my wife opened the door to the office. So hold on.
No, what's true is he's just going to get more cereal. He was having some before the
No.
show started. Okay, all right.
The point is that because we have a ridiculous KYC AML process in this country that doesn't really work very well, all these companies have to have enormous, valuable to scammers databases of all personal information. This hack could have just as easily happened at Robinhood. The only reason it didn't is because they managed to find lower price people that were offshore in Coinbase that were able to do it. But it could easily have happened in traditional finance. It did happen with Equifax, it happened with Target, the department store, etc. So yes.
But isn't that money all covered by FDIC insurance based,
Well,
and
the FBI, no, here's where you're wrong. If a scammer identity steals from you and can wire money out of your bank account and you don't tell them, you don't notice it in time, the FDIC isn't helping you.
Yeah, that's true. That just happened with my parents 3 weeks ago.
No, it's not. It's a question of timing. I mean, yes, with crypto, it's a bit more immediate, but
so I think that's really interesting. So do you think the answer is less KYC AML and get these corporations?
I think the answer is abstract. I think there's a lot of different answers, and it's time for a different show. But I think there are technological solutions to it in terms of abstracted away. Basically, prove you're a human, in good standing, and separate that from having to have your driver's license and passport and all your information on file with every single organization, many of which have minimum wage or lower employees who could have access to it. That's a real problem, and it does need to get fixed. And there are technological solutions. I saw you nodding, John. I know that this is not a trivial thing for you as well.
No, absolutely. I'm someone who, when you go on Uphold, that exchange Uphold, I was one of the major people that were attacked. The hackers are very sophisticated, and it's some people will be judgmental. Well, you're stupid if you gave up. They create a sense of urgency. It could be Andrew's parents or someone. They get this sense of urgency, and in that moment, it's like the emotion we're talking about trading. Same thing applies, to that situation. And so, no, I agree. But listen, back to the whole issue. I think that this every day it seems like we have a new bullish argument, right? So the strategic Bitcoin reserve was the most bullish thing, and then something else. I look at this big beautiful bill as a big beautiful Bitcoin bill. Yeah. I really do.
It really is,
because it's going to pass. and it's going to increase the deficit by 5 trillion over 10 years, for sure. And we're already at 37 trillion. So I just don't see. You know, I know there's some people out there, and you guys are smarter than me. And Andrew, you touched this before, but whenever I get off a show like this, people will say, and I understand it. Oh, you know what Sailor's doing, and what Maulers is doing, and what now Metaplant's doing, and issuing this debt. They're building so much leverage in the system, it's gonna explode, just like it did with FTX and all that.
Yeah, and what I would say to them is maybe they should put their face on their avatar and be serious, and then have a serious discussion about it. Most of the people that are saying that are we don't even know who they are. They have no skin in the game. They have no idea what they're talking about. The reality is those people are using what's available to them to buy Bitcoin for all intents and purposes. The way that the current traditional financial systems are set up, they have access to capital. Banks give them access to capital. They use that capital and then they buy Bitcoin. That's pretty much the reality of it, right? We're not at a point yet. We may be at a point, and Dave can speak to this in the future, where there's additional leverage in the Bitcoin ecosystem that we should be concerned about. But right now, that really doesn't exist. We're nowhere near that reality associated with leverage that's problematic. Just absolutely not.
That's right. And look, you'll know it because you'll see it in the derivative markets. And you're going to see mini boom bust cycles based upon excess leverage. It always happens. But the kind of leverage that we're talking about here, look, it's been used for years. If you think Berkshire Hathaway wasn't built using derivatives, you're nuts. I can tell you, everyone in the fixed income derivative markets and some of the equities, but mostly fixed income, will tell you that Munger and Buffett were sharks. They were among the most astute derivative traders on the planet. Well, what do you think that is? That's leverage, baby. That's what they were doing. It's the same stuff. And that's why Berkshire is actually a really interesting analogy here. There are lots of companies that have done it. Amazon built their entire delivery network based on convertible bonds that they were able to finance, effectively taking their stock's volatility and using it to monetize and get cheap debt. So they were able to build out their just-in-time delivery network. We all use it now. No one thinks of that as a bad thing. But, it's like financial engineering is financial engineering. The most important point about all of this is a chart that I think it's Jesse. I think it's Croesus. You know, Jesse, he created. It's the one that has the little box of Bitcoin at the top that's 0.2%, and then the boxes of all the percentages of all the assets. It's a very famous one. The market in crypto is tiny relative to the global financial system. So if you start dipping your little pinky toe into the global financial system for leverage, it could overwhelm the price of Bitcoin. So right now they're dipping like a little teeny, it's like a microscopic amount into the global financial system. It might look big in the Bitcoin world, but $2 billion to a $300 trillion economy is a really small number.
I figure when we match, when Bitcoin matches gold's market cap, then I think maybe it'll be.
Well, yeah, there'll be plenty of times for booms and busts along the way before we get there, but I think that's inevitable now. That's the funny thing. And people think of me as crazy for saying it in TradFi. And then I start talking to them for a while. And generally, at the end of that conversation, if there were 3 or 4 people there, 2 or 3 of them end up orange pilled and they open their first Bitcoin account or they do their first trade.
And isn't gold like 20 or 21 trillion?
Gold is 22, but I figure 90% of gold is monetary and the rest of it is jewelry. So you're figuring somewhere in the neighborhood of 19 to 20 trillion dollars of market cap would be about pari passu. I did the math on a tweet the other day. Basically, the way you're using the gold silver ratio. Silver is about 30% monetary because of the coins and bullion in existence. And so you end up with, it looks like about 90% of gold is monetary. And the easy way to explain it to the women in your lives is if they have a memory, like my wife's wedding ring is platinum. Platinum is 30 times rarer than gold in the Earth's surface. Gold is 3.5 times more expensive than platinum right now. And when you say that gold's more expensive than platinum, they're like, no, that can't be. It's like, no, look at it. Didn't used to be. It's because of the monetary side.
There is, again, the thesis here. There's a reason that, Larry Fink, again, in conversations that are notated, are going to live forever. and associated with things like BlackRock's, quarterly earnings reports, talked about the fact that he thinks if we get to, let's call it 1 to 2% exposure to Bitcoin across the world of wealth management, we're at 500 to 700K on Bitcoin. And in my mind, that's a reality. There's a reason why Larry is saying it, because that's where he thinks it goes.
Yep.
And I also think that at those levels, we will probably that's when we'll begin to see the financialization of Bitcoin and leverage begin to really play a part.
Yeah, I think it'll be more cyclical than you do, but I do think we get there for sure.
Yeah, and I think that I come back to Jeff Park at Bitwise, who's he's a smart guy, put it that way. He put out a paper, let's call it 6 months ago, associated with Bitcoin options, and is there a moment where we have just an insane gamma squeeze that pushes Bitcoin higher in ways that we haven't considered? That is still out there, right? So to the point about leverage, we're nowhere near any of that right now, but we will get there. And so you want to be involved when we get there. And oh, by the way, you probably want to be using automated tools when things like gamma squeezes to the upside or to the downside happen in your spot Bitcoin position. Maybe I would think that would probably be smart, right? Yeah.
Yep.
Those are the most emotional moments.
Yep.
No doubt about it. Well, we're going to close this out. Thanks everybody for spending time with us. John Deaton in San Diego, stay classy. Dave Weisberger, thanks for joining us. Daniel Tillman, fantastic. Thanks everybody for being here.
I'll see all you guys in Vegas, right?
See you in Vegas.
Look forward to it, John.
All right.
There. We're all going to be there. Yeah.
It's going to be a great time.
Absolutely.
All right, everybody. We'll see you later.
Thanks,
Thanks.
guys.
You bet.